Appreciate it. I have a couple questions, and I will turn to my colleagues that remain. Just to remind everyone, I am not the CFPB. The hearing today will focus on what we're going to do as a state. I do appreciate the overview from everyone, but going forward, I feel like we've already at length debated what we think will come out of the CFPB's work. We obviously know that is, as a commissioner stated, either a cloud of light or dark nature hanging over us. But for the rest of the panelists, I would ask you to keep your comments directed mostly to the work that we'll do here in the state to either expand, supplement, or improve that work. Very quickly, Mr. Shaw, what would good underwriting standards look like as we move forward based on not only what the CFPB is going to do, but what we're doing here in California for your products?
I think a good underwriting standard would take into account the income, the credit experience, any credit rating, the bills that a borrower must pay in addition to paying off the loan itself. And these should all be used as background to establish whether or not the borrower can pay. One of the fundamental differences between us and the CFPB is their utter unwillingness to use their own enforcement and examination mechanism to chart how well an operator has done this duty. In other words, it seems to us that there are literally dozens of ways in which to assess ability to repay. There is not one, and of course the residual income test which they've chosen is being used by how many other entities? None. None. They admit it themselves in their document. So why discourage people from using any reasonable test and find out how well it works when you examine them? At the point you examine them, you'll find out how many defaults, how many problems there are.
Thank you. Mr. Leonard, would you concur with that, or would you like to add anything to what?
No, we strongly believe that having, the CFPB has in fact established a precedent for looking at borrowers' incomes, credit capacity, and do you want to get that?
Oh, sorry.
The hearing. Sorry.
Go on, please.
I can get it for you. No, that's all right. So the with its mortgage rules, it's already begun to establish this precedent that lenders would be required to examine borrowers' income, verify their income, review their debt obligations, their credit capacity, and their expenses. And expenses is really important because, as we noted, many borrowers we know don't have thick credit files as it is, and so those day-to-day expenses that borrowers have, which will very much determine whether or not a loan, and particularly a balloon payment, 2-week balloon payment loan, is affordable, will have to require looking at what the borrower's expenses are.
To follow up on that, Mr. Lynn, would you consider the ability to repay standard not only the biggest obstacle we're facing, or would you consider that to be key to making these products fair going forward?
We at the federal level, we think that ability to repay, meaningful, standardized ability to repay across all loan products, not just payday loans, not just CFL loans, not just CFL loans between $500 and $2,500, but across all of the CFL loan products, is absolutely essential. At the state level, however, CFPB is prohibited by federal law from looking at interest rate limits. And so one of the other core items that the state needs to be looking at, which the CFPB cannot look at, is establishing interest rate limitations, which we have on CFL, we have on payday loans, sort of. We certainly have some fee limitations, but 459% APR is not a meaningful limitation in my view. But we have limitations up to 2,500, and then we have this above 2,500. We have no interest rate limitations. That's something that's critically important for what the state needs to be addressing as well.
We're going to, I think, try to move on very quickly, but just 2 follow-up questions, and then I'll go to Ms. Brown if you'd like to, and if the Vice Chair would like to say anything. In previous hearings, we've gone over a number of options that consumers have in terms of financial products. I think it's clear that we're moving towards a different type of option to be providing, I think, hopefully a better product in the future. Mr. Leonard, though, if we eliminated payday lending or restrict other lending to the point that it goes away because we have not allowed these businesses to stay in business, what options do consumers have, or will they have any options for non-bank credit And what do you think these options should look
Well,
like?
first of all, I think it's a mistake to take bank credit out of the conversation. I mean, bank credit is, and particularly through credit cards, is the way that the vast majority of Americans deal with their short-term cash
Wouldn't you
flow.
agree that people can get in almost or as much trouble with credit card debt that they could with a payday lending debt?
I think fundamentally no. I think because the essentially interest rates are much more limited. There are possibilities. There's some outlying examples, and there are some very, very expensive fee harvesting credit cards that are still allowed under the Federal Reserve rules. But that said, I think the idea of somebody who has not enough money today and needs to take out a $255 loan and is going to pay $45 every 2 weeks for as long as they may be necessary or may be likely to default at the end of a spell, I don't see any credit card products having that kind of a demanding payment schedule.
May I say, Mr. Chairman?
You will. And will you hold your comment? My question to Mr. Lillard is this: and would you say that interest rate or underwriting, what would be your main concern, or are they equally as important to you?
I think both are absolutely essential.
Noted. Mr. Shaw, and then I have a follow-up,
Yes,
Mr. Shaw, as well.
Certainly. In the last 3 weeks, the American Bankers Association has released a survey on unsecured loans made by 99 banks surveyed. Less than 1% of those loans, unsecured, were made by any bank under $500. Banks have been in this area, and the fact is they were not profitable. One of the great changes that I do not believe our opposition really understands is the nature of the change in credit. Banks are no longer able to successfully operate in this area because they must view each customer who comes through the door as a profit center. And that stems directly from the fact that after 9/11, compliance costs for banks have risen by a factor of more than 400%. The second point I would make is loans, interest caps on loans were considered in Dodd-Frank, and they were rejected. Not only that, but it is the one area in which we might find agreement between a liberal economist like Paul Samuelson and a great conservative economist like Friedman. The two of them both agreed that all interest caps do is create a balloon bulge in the market. They do not serve customers or the demand for credit well. And third, I would just say that when you talk about what will happen, we know what happens by virtue of how many people who once had access to payday loans legitimately through the state now don't have it and seek those loans online at their peril.
Ms. Brown.
As we're talking and as I'm listening to this discussion, it seems like the people who are using the service are not here, or not, they're missing in this whole thing. If you need money to fix something on your car, to buy a tire, if your kids need something, you're going to need that money, and you're going to go wherever it is, wherever you can get it. Now, back in the day, there were loan sharks. Are we going to go back to that? I don't understand. I mean, I'm looking at both sides of it. This side says that there's no regulation, or the regulation is limited. This side says let's keep them from getting the loans. We got to come somewhere in the middle, it seems.
I mean, one of the ways that I would respond to that, I think that, I mean, if you look very closely at the DBO data, and I'll share the report that we've just published for my next testimony, I mean, one of the interesting things that tests some of these assumptions is what's been happening above 2,500, where we have no interest rate limitation. And by and large, we've seen very little lending in that activity until the last few years. And we have seen a big growth, as the commissioner mentioned. But the absolute number of loans made above 2,500 is now about equal to the number below 2,500 under the CFL loan. Now, one of our fundamental principles here is let's have a set of common standards, and let's also look at what's happening in the pilot loan program, because we're seeing steady traction being made by one lender so far predominantly, but others that are getting in, who are making loans for a fraction of what the high-cost installment lenders or the payday lenders are charging, and are doing it in a way that is leading to profitable lending activity.
So if that's the case, though, if that's the case, wouldn't everyone gravitate to them?
Well,
And the market would hold, the whole thing would change?
I would like to believe so, but you have some institutional barriers to that. You have the presence of over 2,000 payday lender stores that are all around our communities, particularly in low-income minority communities, by the way, here in California, and they are readily available. I mean, so that's an infrastructure advantage that those lenders have, which is not something that can be. I mean, above 2,500, there was a comment in the briefing paper that the $5,000 limit for removing the interest rate limits was reduced to $2,500 under the notion that there would be more competition in the setting of interest rates below $2,500. We have not seen that, really. That has not played out since that change was made. What we see are 200% APR interest rates for loans above $2,500, many of whom have very high default rates as well. And that's not the kind of responsible business model we would like to see serving our consumers.
Thank you, Paul. We will move on to the next panel. I will ask both of our panelists that we did give extra time to today. One of the things we did not get a chance to mention, and I would love to get your feedback after the hearing today or through email, is one of the states we've been looking at is Colorado, who in 2010 reformed their payday lending law. It has not been a perfect situation, but they turned their loans into a longer installment type loan. This had the effect of reducing same-day loan renewals by 40%. I'd love to get both your thoughts on that, maybe through email or by talking to Mark, and we'll share that with the rest of the committee. But that was an interesting case study that we're still looking at in Colorado. Thank you for that.
My pleasure.
So we're going to break up the next panel. We're going to ask Raul Vasquez, CEO of Opportune, to come up. Paulina Gonzalez, Executive Director of California Reinvestment Coalition. James Gutierrez, CEO of Inskit. Dan Gonalti, President of California Financial Services Provider. And Sofia Garcia, State Director of Government Affairs for Advance America. And then we'll have the next group come up right after that. Then let's lift the call.
Are we going to have any? Are we going to have any people use these services? Speak to us at all?
We are in the process of working. We offered that. We didn't anyone take something off.
Lifting the call on AB 268. Allen?
Aye.
Allen, aye.
Okay. We're missing one person. They're not here. So, Mr. Vasquez, if you'd like to start.
Okay. Mr. Chairman and members of the committee, my name is Raul Vasquez. I'm the CEO of Opportune, formerly known as Progreso Financiero. We're also the large lender that Mr. Leonard was just referring to in terms of the company that's really gotten traction under the pilot program. Certainly at Opportune, we applaud the chair's efforts to take a fresh look at the California Finance Lenders Law in order to determine how it can be improved to serve the needs of the consumers. Given that objective, I'm going to focus my comments really in just a few areas. Number one, the lending program known as the pilot program for increased access to responsible small dollar loans is successful, it's growing, and we believe it provides valuable earnings for the efforts that you're undertaking. And then number two, I'll spend some time talking about the specific learnings that we think can come out of that program to inform your efforts. And then finally, I'll offer maybe one sentence or two sentences on our thoughts on the CFPB proposals. Before we dive into those areas, I'd like to tell you a bit more about Opportune and the lending experience that we have that informs our perspective. Opportune is a California financial technology company that is using technology and big data to improve the making of small dollar loans. Opportune is headquartered in Redwood City, and we're a mission-driven company focused on serving Hispanic individuals with limited or no credit history by offering credit-building loans at responsible and affordable rates. Nearly half the individuals that come to us without a credit score, and nearly 90% of our customers live in low and moderate income communities. I think think has been mentioned a few times, our customer is the type of customer that has very limited options when they have a need for capital to take care of expenses, be it the car that won't start, the need that children have for certain things. Our success in pursuing our mission is validated by the fact that the Treasury Department is certified as 2 different times as a Community Development Financial Institution, or a CDFI. Those of you that may not be aware with it, a CDFI is a mission-driven financial institution that is dedicated to providing financial services to meet the needs of economically disadvantaged individuals within underserved communities. So it's very consistent with our mission. From a quantitative perspective, just to give you a sense of our scale, we have now helped more than 540,000 Californians by lending over $1.8 billion across 1.1 million loans in the 128 locations that we have in communities throughout the state. Today, we only do storefront. We have started testing allowing customers to use our process through computers or mobile devices. Achieving the results that I just talked about has been particularly gratifying for me because although we've been making loans since 2006, almost 90% of the volume that I just mentioned that we've lent has been done in the last few years while I've been leading the organization. And also in that time, we've gone from being a company that lost money to a company now that is profitable. So the loan volumes that I've mentioned make Opportune the leading lender under the pilot program and a leader in responsible lending here in the state of California. So now, very briefly on to the specific comments.
You have about 1 minute left.
1 minute, okay. You're familiar with the pilot program. The DBO earlier shared the elements of the pilot program that we think are so successful, and the fact that a lot of what Mr. Leonard mentioned in particular, requiring the ability to pay, that be verified, minimum terms in months, not weeks, mandatory reporting of loans to credit bureaus, credit education that is provided before loan disbursement, conditions on refinancing of the loan balance, and a ban on the requirement for borrowers to waive their right to sue. All of those elements we think are very important and things that should be considered in your efforts.
You report on all your loans?
Yes, we do.
You do underwriting on all your loans?
Every single one.
Interesting. Okay. Before we go to our next speaker, Mr. Leonard, you still have a seat at the table if you'd like to retake it. If not, we can. Okay. So, with that, Ms. Vasquez, if you'd like to go next.
Ms. Vasquez or Ms. Gonzalez?
I'm sorry, Ms. Gonzalez. I'm sorry.
Okay.
We're looking at the next panel.
Great. So good afternoon. My name is Paulina Gonzalez. I'm the Executive Director of the California Reinvestment Coalition. We are a statewide financial justice and economic justice coalition with over 300 organizational members across the state. I know firsthand the needs of our communities, not only from the work that I do in the communities that CRC represents, but I know this because this is a community that I come from. I grew up in working-class South Montebello in an immigrant family where we struggled to make ends meet. But luckily for us, we never had the option of taking out a payday or installment loan that would have left us in a worse situation. CRC's members work on the front lines of California's low-income communities and communities of color. Our members are affordable housing developers, CDFI small business lenders, asset-building organizations, and tenants' rights organizations. Our membership serves the constituencies that are the target of the aggressive marketing and outreach efforts of high-cost lenders, and they are located in low-income communities where payday loans and installment loan storefronts are heavily concentrated. They serve the constituency that therefore often fall prey to these high-cost products. The lobbyists and corporate executives of the predatory lending industry say that they know our community needs and that they are providing a service with their products by helping families during an emergency when they can't pay their rent or when their car breaks down, that they provide a last-ditch option when our communities have no other option. But really, the so-called service they are offering is analogous to offering a starving man poisoned food. These products leave families in a worse situation than when they started. They leave families thousands, if not tens of thousands of dollars in debt, paying 100 to 500% above the principal over the term of a loan. This is the DBO's data of regulated lenders, not offshore lenders. CRC agrees with the general goal and principle of expanding access to credit for our communities, particularly for underserved populations. However, we want to ensure that that credit that is being offered is fair, affordable, responsible credit, not high-cost predatory loans that trap borrowers in a cycle of debt. We do not believe that high-cost credit, in other words, that poisoned food, is the solution for our communities. We are concerned about the weak legislative and regulatory framework governing payday lending below $300 and card title and installment lending over $2,500. The failure to regulate this lending space at each of the lending spectrums allows for lenders to conduct high-cost predatory lending with impunity in this space. At one end of the spectrum, in the under $300 range, you have unregulated interest rates and APRs as high as 450% on these loans. In addition, you have a business model that relies on repeated borrowing. The CFPB just last year took an enforcement action against Ace Cash Express, one of the largest payday lenders in the country, because they found that they used illegal debt collection practices, false threats of lawsuits, and criminal prosecution. Their own training manual showed it. They pressured overdue borrowers with these illegal collection tactics. They used weak underwriting, knowing people could not pay the loans, and then they used these tactics to ensure that they took out new loans. On the other end of the spectrum, in the above $2,500 range, the business model is based on triple-digit interest rates that force consumers into loans that can take a decade to pay off. So imagine taking a $5,000 loan and paying $30,000. Consumers in the middle lending space that encompass the pilot program have the most protections. There's a usury cap, some underwriting, and there's reporting to credit agencies. What we should be discussing is strengthening the middle lending space, extending the protections of the pilot to more people by regulating the $300 payday lending space and the above $2,500 lending space. So what we're asking today is that as we regulate, that we think about underwriting requirements that take into account income and expenses to ensure borrowers have the ability to repay the loan, interest rate restrictions and fee caps of 36% APR or less, protections against expensive long-term debt, such as limits on reborrowing and refinancing. And lastly, we're encouraged by the forthcoming CFPB rule, and we are working hard to win strong reforms and establish a national floor for consumer protections. We do believe it's premature to change the CFLL given the impending changes in federal regulatory requirements. If you are going to proceed anyway, the focus should be on regulating the ends of the spectrum, leveling the playing field to protect consumers from high-cost predatory loans, and therefore expanding access to responsible, affordable credit. Thank you.
Ms. Gonzalez, I appreciate your testimony. Before we go to Mr. Gutierrez, I would just like to reiterate a question that I asked Mr. Leonard. Clearly, you're putting most of your eggs in the basket of the CFPB, but in terms of our work here today, would you consider underwriting or credit scores and looking at ability to repay more important, or would you consider the interest rate component of this? And you talked about these products being offered as a poison food to families, but I think Mrs. Brown made a very compelling argument, much like the student in my survey, where she said, listen, I didn't have any access to a credit card. I needed $300 to buy student books or books for her classes to continue her studies. Her alternative was to wait 3 weeks until she got her money. She did not have family she could borrow from. What would you tell that student, and what would you think would be a reasonable approach to taking upon underwriting and making these products more feasible instead of just an outright ban, which you seem to be calling for?
So I'm not calling for an outright ban.
Poisonous food seems to be a
well, no, I
statement.
think that the way that the loans are currently structured, they are poison food to starving people, right? That student, right, the person who can't pay their rent, right? You're talking about loans that are structured to that are leaving people in a worse situation.
But
we're seeing
problem or a bigger socioeconomic and income inequality is a real problem for them.
What I think that the pilot has shown and the lenders in the pilot have shown is that the loans can be made and structured in a way where they're affordable and responsible. We're seeing that the biggest lenders in that space are making them in the above $2,500 space and in the $300 to $2,500 space. So, and they're making them at responsible and affordable rates. And so that the student that you talk about, who I have a daughter who's in college actually, and if she couldn't afford her books, or when I was in college and I was struggling to pay my books, that if I needed that loan, that I could turn to a lender who can make a responsible loan. So what that says to me is that the lenders who are making the 150% APR loans, they're choosing to make those loans at those rates and not making them at a business model that would work.
Is what you're saying.